Hi beautiful people, it's your boy Rele and I'd like to welcome you back to the DSI YouTube channel. In today's video, I'm going to be showing you guys how to get these sniper entries on the lower time frame and basically help you guys master the lower time frames like the 1 minute. And this particular lesson today is coupled with a trade explanation or a trade review of a trade that I took on gold on the 1 minute time frame. So make sure to stay tuned till the end of the video, as I will be sharing screenshots of this particular trade that I took right here. So without wasting any more of your time, let's just get straight to it. So basically guys, as you can see, we on the 1 minute time frame right now. I was just moving the recorder. So basically, as you guys can see, we are on the 1 minute time frame. We are looking at gold. I entered right there and my TP was hit right there and my stop loss was right there. So basically, like, the reason why I took this trade, right, I'm gonna first start on the higher time frame so that we can get our our larger time frame bias. Okay, so basically if we go on the 1 hour time frame right here and then try to zoom on in, I want you guys to be aware of something right here on the 1 hour time frame. Let me just move this thing right here. So basically, as you guys can see, on gold we have been like making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and then we currently made a higher high, right? So today is basically today is Monday, right? Today is Monday, the 20th of May. So I basically took this trade I think at around 11 at around like 11 a.m. New York time, right? As you guys know, we use like New York time, or during the 11th hour, New York time. So I'm going to be breaking that down further. So but then I want us guys to be aware of one thing. Like, as you guys can see, price has clearly been showing us that we are in an uptrend. So basically here at DSI, like, the way that we trade is that we are patient. We wait for price to give us our opportunities. We don't go and chase trades and try to force trades. So basically what we anticipate, if ever we have had like an impulsive move to the upside, we want to first wait for price to come back at either the equilibrium, right, or retrace a bit deeper into the equilibrium, right? And then as soon as it has done that, I'm going to explain what do I mean by equilibrium, right? But then as you guys can see, if we are measuring this leg right here, right, the middle would be our equilibrium, and then below the equilibrium is where we would have our discount, and then above the equilibrium is where we would have our premium. So let me just go in and pull the Fibonacci retracement tool, right? So we're basically gonna be measuring from this low to this high right there, right? There we go. Right, there we go. So as you guys can see, let me just try to make it a bit more clearer. As you guys can see, measuring from this low right here all the way up until this high right here, price came back to the 50%, right, which is basically the equilibrium, right? And as soon as price comes back to your equilibrium, or maybe goes a bit deeper into a discount, right, that is where we start anticipating a market maker model, right? And that is another rule. And then the other rule is that we want to make sure whenever our market maker model matures and gives an entry for a limit or market execution, we want to make sure that we are in the kill zone, right? So I'm gonna clarify on like what do I mean by like we are in the kill zone. So basically, as you guys can see, all of this time that like price has been going up, like all I've done was just sit on my hands and just be patient for the market to basically come back and give me and basically come back to like the equilibrium, or maybe like I was basically also expecting it to like retrace deeper, but as you guys can see, like that didn't necessarily happen. But price basically coming and tapping the 50% was like good enough for me to like start looking for like a market maker buy model on the lower time frame. So as I've said to you guys, I'm going to be sharing with you guys like how to basically like how you can also like master the lower time frame and get like sniper entries on the lower time frames, like your 1 minute, 3 minute, 5 minutes. But in this video I specifically use the 1 minute, and that is basically what I'm going to be explaining. So on your higher time frame, once you've identified your buyers and you have identified that maybe like after you've had like an impulse leg, you started having a retracement leg into your equilibrium or deeper into discount, right? That's when you are going to start to look for the market maker model. So in this instance, since we are in like as you guys can see, we are in an uptrend, we will always want to be like trading in the direction of the higher time frame or the higher time frame trend. And in this case, as you guys can see, it's a bullish trend. So if ever we are going to want to get like like easy trades, we're going to want to make sure that we are trading in the direction of the trend. But it's not only easy trades, but also trades that can yield a very good risk reward ratio, right? As I've shown you in the beginning, that the risk reward on this trade is a 1:4. So we've been on the 1 hour, we are going to tap in on the lower time frame. So yes, we have confirmed that price got to our equilibrium. I'm gonna try I'm gonna basically just delete this for now, and then I'm gonna go in on the 15-minute time frame. Okay, it's still not like it's still not that clear, so I'm gonna try to go in on the 5-minute time frame. Okay, there we are on the 5-minute time frame. So basically on the 5-minute time frame, this is the retracement from the top, and as you guys can see, this retracement on that 1 hour impulse leg, this pullback basically came down into equilibrium, right? So as soon as price comes into equilibrium, what I want to see is a market structure shift. So basically a market structure shift is simply like, as you guys can see, we've been on a downtrend while retracing. What we want to see is the market shifting structure, right? So basically, as I was saying, like what we want to see is the market shifting structure to the upside, right, in the direction of our larger trend, right, or our higher time frame trend, right? So let me just see like this. Okay, cool. So basically a market structure shift, for it to happen, we are going to look at the last in this instance, right, or in this instant, while price was going to the downside, approaching the equilibrium level, right, we are going to pay attention to our lower highs, right? As you guys can see, we had a lower high right there, a lower high right there as well, another lower high right there as well, and then after this lower high, we never had another lower high, right? So meaning that this lower high right there, please guys, don't focus on where my finger is, like this round dot. Please focus on the cross is, right? Yeah, the cross is. So basically this was the last lower high, right? What we want to see after price has approached in equilibrium, right, we want to see the last lower high, right, printed, taken out, right, in an instant where we want to be buyers in the market and be part of the larger trend, right, or the higher time frame trend, right? So that happened. We had a break, we had like a market structure shift where the market didn't necessarily maintain this structure of lower lows, lower highs, lower lows, lower high, lower lows. If this was to continue, we were probably going to see another lower high and then the market continue, going down. But that didn't happen. The market basically ranged and it ranged around and ranged around up until we got to 1544. But this is like I think like 2 hours. There's like a 2-3 hour difference in the time. I'm gonna try to clarify on that. So basically we had a break of structure, like we had a market structure shift, right? So what we normally look for whenever we have a market structure shift, right, is that we want to make sure that price leaves an imbalance, right? And as you guys can see, we're on the 5 minutes, so that means that we will have to go on the lower time frames to check if ever price left an imbalance for us to utilize to to set our limits. So let me just go on in on the 1 minute time frame, and as you guys can see, right, let me just check the time. Okay, and this was, so there's like a 2 hour difference in the time. So basically price broke this last lower high, right, and as it broke the last lower high, if you zoom on right, you can clearly see that there was a gap, a fair value gap, right, or what you would refer to as an imbalance. Okay, and with that being the case, I knew that we are in our time zone. What time was this? 15. So this was using my local time, right? Using my local time, it was basically 5:37 p.m., right? But if I relate that to New York time, it would have been 11:37. So which is basically, it's not the perfect of times, but it's right around that New York kill zone, and you can be a bit flexible, but don't be too flexible with taking trades outside of your kill zone. You need to know your story, right? This fair value gap right here basically allowed us to get a trade opportunity, and the trade was at 5:37 p.m. my time and 11:37 a.m. New York time. So basically this was an AM session trade, and I placed my buy limit right there at the beginning of that gap right there, right, and my stops were just underneath this low right here. And then soon after that, after we got triggered, the market started moving in our favor, and we hit a 1:4 risk reward on this simple trade right here on the 1 minute time frame. So basically guys, that's how you look for trade entries on the lower time frames. You start on the higher time frames, you start on your hourly, for hourly, or even your daily. You try to check out your bias, you try to see in which direction is the market moving, right? And then once you have identified that, what you look for is for price to come back to either an equilibrium or the discount array if you're looking to be a buyer in the longer term trend, or you look for premium if you're looking to sell, relative to the higher time frame trend. And then as soon as you get price, get back to either your equilibrium right? As you saw, we highlighted earlier, as soon as you get, price getting back into either equilibrium or maybe deeper into discount for buys, that's where you start looking for your market maker buy model, and you keep on going to the lower time frame, and you need to always make sure that you are in the kill zone, right? You need to make sure that you are in the kill zone, or maybe like a couple of minutes, right? Like maybe before. Sometimes you might get it like a couple of minutes before your kill zone opens. Sometimes you might get it like a couple of minutes after your kill zone is closed. But you need to be flexible in terms of that, and basically understand your trade model. So I hope you guys found value in this particular video, and you learned how to basically take trades on the lower time frame, take sniper entries like this. And I hope you guys you like this video, and if you didn't understand any of the terms that I used in this video, make sure to get yourself the DSI 1.0 SMC course, right? So make sure to get that. DM us on any of our social media platforms. We're gonna get back to you, and hope you guys enjoyed this video. And if you did, make sure to hit the like button, comment below, share this with your friends, so that they can also find value in this video. And this is it from me, guys. Signing out. Danko.